So with all of that, I know it sounded like a lot of bad news. In a way, it is good news to be an investor at this time. This is all of our data that we just looked at. Okay. And if I zero in on this data set, I would basically build our benchmarks for pre-money valuations based on what we're seeing here, right? In Q1, Q2 of 2023, I think some of the later stage data is actually artificially depressed. So I'm willing to have a higher number at series, maybe C, D, and E. As a broad average, what we are assuming now when we look at median US companies will look like this. A pre-seed company should receive a pre-money valuation of $6 million. Seed stage companies should be at 13 million. Series A, we would price it at $40 million. Series B at 100. Series C, we'll put it at 250. And Series D and E, we go up to 600 and $1 billion. So now let's work on filling in the rest of these gaps. We immediately know how to fill up the step-up multiple, right? Because when we go from pre-seed to seed stage, for example, the step-up multiple, you can calculate it's 2.2, which means that we can fill in the second row, and then the last piece of the puzzle is going to be dilution, and that gives us a view towards the MOIC. So let's solve dilution first. This table here is a rough chart showing share ownership it shows founder ownership or founder equity across different stage of companies. So you can use this as a rough guideline. And the way to read this is that the ideal case at, let's say, seed stage is that founders should own 60 to 70% of the company still at seed stage. And if they have 50 to 60%, it's still okay. But whenever at seed stage, you see a company where the founders own 40% or less, this is what's called a tricky or broken cap table. So if you ever hear that term, a broken cap table, this is what it means. It basically says that the founders own too little shares of the company. So why is this the problem? There's a few reasons for this. One is that as the company progresses from seed to series A, B, C, etc., they're going to keep raising more money, which means that they give away more of the company to new investors. And so the founders own less and less, and so do other investors. The concern here when founders own too little at the early stage is that if they get further along, they own so little of the company that they basically don't have an incentive to act in the best interest because their upside is simply too small. And this is why you as an investor, when you invest, you want to understand what the founder ownership is, because if it's too little at the early stage, it's going to be problematic. Either the founders, they own too little later on, and so they might not act in your best interest. Or another implication of founders owning too little is that future investors might look at the ownership and they'll go, hey, you know what? This scares me too much. I'm not willing to invest in that company. And so it actually diminishes the chances of the company following on funding, right? So there's some very real implications for you, which is why you need to pay attention to this. Now, so this gives us rough guidelines on founder ownership at different stages. And when it comes to dilution, we tend not to see big fluctuations in dilution. There is some variability, but whether it's a down market or up market, dilution doesn't tend to change a lot. The reason is that we see a very clear pattern in capital availability and valuation, which is a very simple way to say that when there is more money flowing into the ecosystem, companies will raise more money and they will also increase their valuation. It very much comes down to supply and demand, right? It's a very primary driver in my view. And so because of that effect, whether it's an up market or down market, dilution tends to stay within a relatively controlled band. And here's the data behind it. So what you're looking at here is seed stage companies. On the left is the median amount of cash raised quarter by quarter from 2020 up to Q2 of 2023. And on the right is median pre-money valuation. And the point here is that you see a very clear pattern in when companies raise more cash, their median pre-money valuation also increases, right? So this is what I'm talking about. When companies have more cash, they raise a higher valuation, and therefore the dilution tends to stay in a narrow band. And it's not just at an early stage, because we see the same pattern at Series A. So this is the pattern at Series A. We see it at Series B. And if you look at Series C, D, E, it's the exact same pattern, right? So this is like why I say this. So let's look at all of this, and based on this data, we can basically give dilution benchmarks. The benchmarks that we are relying on looks like this. We're saying that when companies go from pre-seed to seed, on average, they will be selling 21% of the company to new investors. So there's 21% dilution. And at Series A, we have 20% dilution. Series B, we have 17%. Series C, 13%. And then at the later stages, it drops down to 10% and 10% at Series D and E. So now we can start to put together this table to get a full view of what venture benchmarks look like today. We're saying that at pre-seed, median pre-money valuation, 6 million. So you invested at pre-seed, and let's say you could sell at pre-seed, you would get a 1x MOIC, right? Whatever you invested. If there was a buyer and you got full price, you get your original money back. So your ROI or MOIC is 1x. When you go from pre-seed to seed stage, we see a 2.2x step-up multiple to $13 million pre-money valuation. And after you dilute that return by 21%, we get a 1.74x ROI or MOIC, which means that if you invested at a pre-seed stage, and if you could sell your holdings at seed stage on this median or average company, you would get a 1.74x return. At Series A, we get up to $40 million pre-money valuation, and that comes from a 3x step-up multiple. And after 20% dilution, your MOIC goes to 2.4x. Series B, we get up to 100 million valuation, and after 17% dilution, we have 2.08x MOIC. Series C, $250 million valuation, we get 2.18x. Series D, we see another 2.16x MOIC, and Series E, a 1.44x MOIC. Okay, so high-level averages, this gives you an idea of what to expect across different rounds. Now, another way to put this data together is in the form of a matrix, right, or a table. And here we are just taking that same data and to compute the MOIC. If you think about each of these rows at the entry stages, so if the first row here is if I invested in pre-seed and I exited at seed stage, Series A, B, C, D, E, invested at seed stage and exited at A, B, C, and so on and so forth. Okay, I put this together because we want to show you the effect of compounding MOIC, which is what happens when you invest in a particular stage and you hold on across multiple rounds. You get maybe 1.5x MOIC here, 2x MOIC there, and those numbers seem small, but when you hold it across multiple rounds, there's a compounding effect, right? Because you multiply all of those numbers. So the way to read this chart looks like this. The data says that if you invested into a seed stage company and you held on to this company up to Series E, and this was a very average or median company, if you could liquidate at Series E, you would get a 33x% return on your investment. Okay, so the point here is to illustrate that by holding your investment across multiple rounds, that compounding effect actually starts to stack up. And this is where you start to see large numbers. So the earlier that you invest, that compounding effect should grow. And so this is like the compensation for angel investors for investing at an earlier stage, for taking on that additional risk.